Ba-bum, ba-dum, bum, 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 ba-dum, ba-dum. Tim, how we doing? Tim Quas, founder and CEO of Market Structure Edge. It's good to see you. How we doing, Tim?
Well, thank you. Good to see you guys as well. How are you? You guys,
I'm
you've got some energy for a
yeah,
Monday.
feeling it,
We
man.
try.
Woke up a little earlier, and one thing that I woke up earlier looking for, I was like, man,
Hmm.
where did the missing Nasdaq rebalance go? Do you have that milk carton? Because I've been looking for it, man.
Did you work over the weekend coming up with that, Mitch?
You like that one? The old,
You definitely did.
missing, the old missing person on the milk carton.
And Dennis, did you see anything?
No, it was supposed to. Invesco said they would announce the changes on July 14th, and somebody
Right.
just, I think, dropped the ball and they didn't announce it. I've never seen that before.
Someone took the day off.
Unless I missed it. But I asked around, and I'm like, I don't see. They said they were going to announce the official new weightings on the 14th, and then the rebalance on the 24th. I think everybody was thinking it was going to happen after the bell, but I don't know. Maybe they just got busy. So maybe it gets announced today. It'd be nice to know. Are they still going through with it? Maybe they decided to abort mission. I don't know, Tim, but I did not see it.
It's completely head scratching to me too. I have never seen that happen where you put out an official press release saying you will do something and it doesn't get done. I don't know. And it's not a minor thing. It's a major chunk of the U.S. equity market and nothing. So I don't know. It's what does it mean for us? It's hard to say. I find there's a curious confluence of things that are occurring, and they may be related and they may not. Number one, there's been some discussion about how the movement in the market has broadened out, that the concentration that had occurred in the first part of the year, basically through June 30, where a handful of stocks, 7 stocks, 8 stocks, I guess you could stretch it to, were responsible for nearly all of the gains, that has broadened out in July. Is it related? Well, it could be. I mean, it certainly could be. If you're big institutional money that believes that the weight in the market is going to shift, then you're going to make some moves ahead of that. Number two, this is interesting too to me. When there is uncertainty, short volume declines. I've had these discussions over the years with true shorts, people who short the market, and there aren't very many, and it's difficult. 2022 was a pretty good year for the shorts, but it's interesting that in the last 5 days, if I look at SPY and the S&P 500, there's been a fairly distinct decline in short volume. To me, that's an indication of uncertainty. And you say, well, wouldn't they short a market where you're going to rebalance away from the pillars that have carried the market into other things? No, because you don't know. When you don't know what's going to happen, you reduce your exposure to the market. Third, broad sentiment is, and I've got 4 things I would point to. Third, broad sentiment in the market as measured by market structure. There are various ways that you can measure the market. So I'm distinguishing it that way, is topped right into earnings and options expirations, which began on Wednesday. And generally, that precedes a rebalancing of the market. So is the market already participating in that? Possibly. And then fourth, in September of 2018, the S&P Global created the communication services sector. There were only 3 telecom stocks left in the telecom sector. And this is when firms like Netflix, Meta, etc., shifted to communication services. Disney's in the communication services group. And we were looking at the data as that was occurring, and we thought, wow, that doesn't look very good. It looks like the market could tip over. And I'm not saying it was the only thing, but at the end of September, the market began to deteriorate, and then it tipped over in October, and we didn't recover till after Christmas of that year. And the market fell 20%, if you'll recall. I'm not saying that's going to happen at all, but I looked at the data the last 3 days. Believe it or not, as good as the market has done, we had the biggest spate of selling. If you look at how stocks closed relative to midpoint prices that we've had since the June, it's actually bigger than the June expirations period. At the June expirations period, the market declined about 2.5%. That's not very much. The S&P 500 moves 2% every day. But I put all those things together, and I think that there are tectonic shifts that are occurring that we might not be prepared for. I might be wrong. Everybody who tries to point out what the market's going to do is often rendered a fool. But I look at those things, and I think we don't have our eye on the right thing at present. So I would say to traders, be careful. If you're risk averse, it's a good time to be very careful about the time frames that you have exposed to the market and what things you have exposure to.
Especially in a time like this. Now, let's start taking a look underneath the hood. Of course, market structure edge. Let's take a look. Should we be watching momentum or low volatility going into this week? Is something that we can definitely take a look at. And I remember last week we were pretty low on momentum, yet some of those momentum names definitely had some momentum. So let's take a look and see what they're showing now.
We highlighted Carvana. Remember, we talked about Carvana. Yeah. That was the first stock that I said, look, it's in the, that's a great momentum play. There were some, but not a lot. The great boom in momentum that we had back in following May expirations certainly had diminished. But people will look at the technicians who will look at moving averages. I'm not a big fan. You guys are good technicians. I'm not. I admit I am skeptical and wary of technical signals because I think they're often lagging. That moving averages tell you what has occurred, not what will occur or what is occurring. But the technicians will say, well, the market has momentum because we're above some long-term moving averages, and generally that can be the case. And that we've got people saying that 4,500 on the S&P 500 is a level of resistance, and we have people saying 4,500 on the S&P 500 is the new level of support. I don't know. I don't even think about it that way. It's not the way that I trade the market. I trade volatility, and I trade where there are supply-demand imbalances. So to answer your question, Mitch, if we were looking at, we look at the math, and here's momentum and here's low volatility. And there are mathematical formulas that just sort stuff out of the market that are highly liquid and have high probabilities of producing returns using volatility into those. And if you look at momentum, it has 7. And consumer discretionary is the leading category, and passive money, quants, are the leading behavior. But 7 is not very many.
When I look at this exercise with you, Tim, we did this exercise with you last week, and you gave us 4 names in there, and I can remember 2 of them, and they actually went. So it was like, I think Coinbase was one of them that may have been in there last week. I don't know if it was Carvana, but there was another one too. There was 2 that I'm like, holy cow, Tim was all over this one. So now I'm very excited to see what the 7 are, because we got, proof was in the pudding last week.
Yeah, Carvana and Unity that were there last week.
Unity was another one, and that went too. Like it pulled back Friday, but it had a big move there too. What are the 7 that are in there, Tim?
Okay, let's click through them and we'll see. And I'll point this out. This is demand. This green part of the graph. This is supply, and it's a 30 trading day look, just to give you a window on what happened during the last options expirations period. By the way, demand was topped at right into June expirations, and it began to tail off, and supply rose. That's how you know that the market's likely to decline. And you could shift short. As soon as those conditions reverse and demand begins to rise and supply falls, then you're back long. Here, this is the part I don't love. Demand is it's not at 10. So this group of 7 on average isn't getting to 10. The supply side has been the key driver of gains.
No,
but here, exactly. It's that same issue where we're seeing this decline in short volume. Now, how durable that is, I don't know. But here are the 7 that are in there. So Caesars, Burlington, Roblox. This is a obscure Chinese online education company, New Oriental. It's a pretty good stock to trade. Futu, which is it's a financial technology firm. ADRs, Alaska and the airlines, and Snap. I mean, if I took the best out of these, to me, it would be Snap. Believe it or not. And
There's
Snap
a story here too. Yeah, I like the Snap. Like actually, it's been so depressed, it's so beat up, and people have watched Meta, how the big moves have happened there. And they think, like there's maybe that potential for a catch-up trade. Pinterest has come back up. I actually like the Snap pullback here too. I mean, $13. It's a little bit stretched from where it was this 3 days ago at 12. I think there's buyers here too. I actually like this one the best out of those ones you just named as well.
And from a trading standpoint, traders, everybody talks about the pre-market movers, what stuff is rising. I don't love that. That's not the stuff I like to trade. I much prefer something that is declining because I have less competition too for it and I get a better price. But, so if you have a Snap that pulls back, actually, Friday would have been a great time. It's too late for that, but it's a great way to think about this, that if Snap moves about 5% a day, see that 4.9%, that's its volatility, average 5-day average move from intraday high to low. So 13.15 is the price, closing price from Friday. Let's, if it's 12.80 roughly, that's 2.5% ish down, that's half its volatility. With this kind of very strong demand, demand's been at 10 for 2 weeks, and supply fell on Friday. That is an ideal opportunity to make 2 or 3%. And you'd say, well, that's not very interesting. Well, sure it is. That's how Renaissance Technologies made $100 billion. They didn't make it getting 100% return on NVIDIA. They make 1%, 1%, 1%, 1%, 1%. That's how you get rich. Right? It's not taking big chances and betting on red 34. That's how you lose money. But that kind of opportunity is very, very good. Just keep in mind, we're heading into earnings. Things can change. But that's how you look at the data. This is a 90-day view, and you can look back historically. What happened when demand hit 10 and supply declined? The price rose. This whole deficiency in supply then was replaced. See this? So this deficiency in supply became an excess supply, and the price stopped rising. It's still fine, but that you can see that. So you go, okay, well, I'll wait for the next opportunity. When demand rises and supply falls, now I'm back in it. And if you can avoid the declines and capture the gains, that is how you beat the market. That is alpha, outperformance with this taking the same risk as the rest of the market. So you can do that in situations like Snap.
What about Roblox? We should talk that one here too, because RBLX is a widely traded, widely followed retail stock. It's a stock also that has not participated in the recent rally, and you do have a long base here. I actually like this one too.
Yeah. Right. Look,
I'm even writing this one down. I don't have it yet, but I'm writing this one down.
I'll give you the good and bad. So the things that I always check are what's the volatility. It's very similar to Snap, which will tell you, if you're looking for an entry point, ideally, you want it down 2.5%. If it's down 2.5%, 3%, that's probably good. Demand. This is less good. Demand has bottomed at 9. It's not slamming into the ceiling, but still, you have a divergence. Demand at 9 and supply has fallen 2 straight days. The probability is you could make 2% again, and don't be greedy. If you get that 2.5% dip and you buy a position, put your limit up 2%, and maybe your stop down 75 basis points, and take that gain. It's a great way to not worry about things. Will it take a day or two? Probably, but that's the way to play Roblox. It looks pretty good. I don't want to get away from a central theme though. There are only 7 here. There are only 20. 7. There are 20 in low volatility. Ergo, if you're just using those as metrics, they're not predictors of market moves. They're just telling you the flavor of the market. There is much more movement to safety than there is
Yeah.
money chasing volatility. That's really what that signal tells us.
So looking under the safety right quick, let's see what kind
Yeah.
of stocks are showing up there. I know I'm keeping an eye out on certain names, whether it be will the defensives get a lift or maybe will industrials get a lift, some value names there. Let's see what's showing up here in the low volatility names.
Okay, and look here, 20, healthcare is the top category. It just means that if you looked at all the sectors, might only have one more than some other sector, but it tells you that's the leader. Demand right at 5, supply falling. If you take an average out of the group, again, passive money leads everywhere. I mean, it's either going to be machines or models. That is what dominates the market. It's why the people who talk about fundamentals are often wrong, because fundamentals do not power the market. Machines and models do. And it's also why technical factors often don't work.
Agree.
Because what determines the direction of the market is really, are we more exposed to equities or less exposed? So looking into the low volatility portfolio, you're going to find things like Monster beverage. One thing about Monster is it is in the Nasdaq 100. Could it benefit from I'm in Steamboat, so maybe the bandwidth hasn't awakened yet. This doesn't happen if I'm sitting in Denver, by the way. So we're slower in Steamboat Springs. But
we got to get you that Starlink up there, man.
Exactly. I'm gonna have to call up Elon. So here's a notice. They all share these.
Monster was like one I was looking at. Yeah, it's a nice one there mentioned.
See this? They're all 5s. So what 5s are very stable stocks, and they have, look at this, they have half the volatility of low volatility, lower risk. So you can set your, you set your stop down 50 basis points or fewer, and you have much less risk, but you're going to get a smaller return. You're after just a 1% return. But I traded this group all last week and did very well. Just taking 80 basis points, 1%. If you don't want much risk, this is the way to do it. But
Tim, this is actually littered with, and it's interesting, it's littered with QQQ lower components here. And it's obviously just, I don't know if it's coincidental or not, but we talked about that potential for rebalance in some of these lower components, which I like, for this week, potentially outperforming because of that play that, hey, some of this waiting for the bigger ones might go to the little ones. If you look like Monster Beverage is in the QQQ. You look, I'm just going for my number. AEP is in the QQQ. GEHC. Zoetis is in the QQQ. GEHC is in the QQQ.
There
CBS
you go.
Not, but WBA is. Ross Stores is in the QQQ.
Yep.
I'm just, grabbing, and I'm just going to try to verify. There's more here, though. I'm looking at almost half of these names are in the QQQ. There's only 100 companies in the QQQ, so that's very interesting.
It's statistically significant.
Yes.
It is.
Definitely.
It absolutely
something
is.
to catch, right? Especially when we're waiting on that rebalance.
Yeah. If it ever comes.
Yeah. Right. If it exactly.
The stocks might be showing us something, though, right? I mean,
I agree.
And they could be finding it here.
I absolutely agree. Yeah. And realize that the reason there is so much concentration, and I'm talking to you traders, not Mitch and Dennis, you guys know this.
Yeah.
That 7 stocks were 55% are still 55% of the Nasdaq 100. So to absorb a meaningful shift, there's the reason that happened is because it's so easy to get in and out of those big 7, right? I mean, Tesla and Nvidia alone trade $60 billion of stock a day. Put them together, they trade 2 or 3 million times a day. Right, so not shares, times. That's how many trades there are, and 95% of trades are canceled. So it tells you how much activity there is in those stocks, because giant money can get into and out of them. If that giant money has to scatter and fragment and drift down into these other things, it gives us opportunity. It absolutely could give us opportunity to produce returns, but it could also be disruptive to the market. And so just things to be aware of.
And one that catches my eye on here, of course, the good old stock that doesn't seem to turn around since 150, Apple. And we know if Apple's showing up on here, if it wants to go higher, that's usually going to pull us a little bit more. What do you think about Apple showing up on there, Tim?
Well, it's head scratching, Mitch, because it's one of the ones that stands to lose assets. And yet you look at Apple here and 1.3% volatility, hardly any. It's about, it's not quite half, but it's 40% below the average in the S&P 500. Very stable stock. So if if you want a low volatility weighted exposure to the S&P 500, you're going to look for stocks like this. And a lot of big pension funds want that kind of product in the mix. And so that if it's facing a significant reduction in the exposure of assets, it's curious that it's sitting in here, right? Does that tell us that money may not necessarily follow the rebalance? I don't know. It's going to be interesting to see. Look at this massive drop in supply for Apple. Apple was heavily shorted, and that's why the stock came down. But all of that has gone away. And so I'd look at that and say, well, it's not that Apple is set to move much, because see, demand is flat and supply is flat too. It's come down. So it tells me it's very safe, but it's curious. You would expect to see sort of the opposite of that if everybody thought money was going to re-weight away from Apple. So I find it head scratching. It could mean that a lot of these models, no matter what the recalibration is, are going to stick with these big stocks because they don't have any choice.
Yeah, that's how I've been seeing it a little bit, and I think we'll definitely find out from the rebalance. But I think, a lot of people are expecting to maybe see those bigger stocks go down a little bit more, but they're just hanging in here. I know that there was a couple that did show a little bit of some blow off tops. We'll see what happens. Like always, you guys can keep up with Tim Quast. Definitely give him a follow on Twitter, and definitely check out Market Structure Edge. I'll throw up the link in the chat if you guys want to go ahead and check out this data for yourself. All right. It's always good to have you, Tim. We'll see you next time.
Thank you. Good to see you guys. Have a great week.
Take care. Enjoy it.